Golden rules of spread betting. Plan your trades. Trade your plan. Trading with a plan. At the very least, you should set objectives before you act. Try to define what you will do whatever happens and determine the amount of capital you are willing to risk. Don't forget to decide when you will take profits, and you must have a specific target. We often decide on a target where we will close down 80% of our position and let the rest run until either it hits our stop or the trend obviously changes. Whatever you do, don't become a casualty of emotionally involved buying or selling. Trade with a plan. Screen your trades. To select your shares, you must have a predefined method. We primarily use software from ShareScope and StockCharts.com as the main tools to help us determine which markets are worth trading and whether to go long or short. You too must select a method, perhaps based on price momentum and trend. Don't guess what the future is going to be. Ideally, trade the current trend direction. We also suggest your own method, and it should consider your level of risk tolerance and how long you intend to run your typical trade. We pay close attention to sentiment and fundamental factors, as we are interested in these things, but you may decide to just focus on technical analysis. Whatever you decide on, stick to it. Always look at a chart. Never enter a trade without looking at the chart first. We suggest you look initially at the 1-year trading range. Work out for yourself what trend is in place, if indeed there is any. Buying and selling decisions should be technical in nature. Remember that the fundamentals may be interesting, but they will never tell you when to buy or sell exactly. Always look at a chart for entry and exit timing decisions. Stay with a trend. Your overall probability of success is far greater if you stay with a definable market trend. Statistically, these trends provide better profit potential with a lower amount of risk. Consider if you had gone long on gold back in January 2009 when it was at around $720 an ounce, and recently, April 2010, it had climbed to some $1,100. With most spread betting companies, this would have generated a nice steady profit gain of 1,300 points over a year. Of course, this is easier said than done. But if you can hang on, you get to the point where the intraday moves don't really bother you. A good rule is to watch a 50-day daily moving average, using just closing prices to identify a trend. This moving average represents the intermediate trend of a stock, commodity, or index. A shorter-term moving average, such as a 12-day or 20-day moving average, can be used as a trigger to open or close the bet. So if the shorter-term moving average is below the 50-day, but then moves across to the upside of the slower-moving 50-day, that would be a buy signal. The reverse action would be a sell signal. The use of two moving averages like this should yield good results in keeping you in the trend. If you perceive the trend beginning to change, act accordingly by taking profits or placing stops to protect your capital. Buy and sell on confidence. Sometimes you won't feel quite right about a buy or sell decision. If this feeling persists after you have done all your research and you have followed the rules to this point, don't take the trade. Too often people try to rationalize a decision. Don't try to find a good reason for making a bad decision. Your decision must be a confident one. Otherwise, just stay out of the markets. For more information, visit www.spread-betting.com.